Welcome to my channel. Please like, comment, and subscribe. Today we are going to talk about the function of central bank. The modern banking system is the two-tier. This means that at the bottom there are commercial banks, for example, the banks that we interact with on a day-to-day basis. They are then managed by a central bank, which form the next level in a hierarchy. The modern banking system provides central bank with considerably more rights and responsibilities. In this video, we will study the core functions that are performed by the modern-day central bank. The most important functions are as follows. The first is monopoly over issues of currency notes. Prior to the introduction of central banking, every bank could issue its own notes. As such, the economy would be flooded with thousands of different types of notes. The people accepting these notes would have very little idea of what the notes were worth or could be redeemed for. As such, there was less trust in the banking system as a whole. This is when the central banks took over. Central banks in modern times have been granted the sole right to print and distribute currency notes. The notes that they print are considered to be legal tender. This means that they are the only legally accepted form of money, and the courts will only enforce that if they are denominated in terms of established legal tender. Therefore, modern-day central banks have monopoly over the issue of currency notes. They are in position to ensure its acceptability and maintain its value without the intervention of competing market forces. The next is control over monetary policy. Central bank in today's world not only issue the currency notes, but they also determine the amount and timings of such currency issue. The modern day monetary policy has virtually moved out of the realm of the government and into the realm of central bank. Central banks are supposed to be free of political influence. In theory, this means that they would not inflate or deflate the currency of the nation to meet political objectives. It is for this reason that governments all across the world have minimum influence on monetary policy. Rather, it is the central banks that decide the quantum of money and credit that circulates within the economy at any time. The next is bankers' bank. The central bank provides stability to the financial system by controlling the action of the commercial banks, and the central banks does so by making it mandatory for commercial banks to have a certain percentage of the deposits maintained with itself. By controlling the amount of loans that the commercial banks can make and the way in which they manage the deposits, central bank can prevent mismanagement of funds by their subordinates. This put them in a position to guarantee a portion of this deposit to the general public, which creates confidence and in the bank system. And then the next is lender of last resort. The central bank is considered to be the lender of last resort for all commercial banks under its domain. Many times banks face liquidity issues, and in such scenarios a run on the bank becomes inevitable. Without the help of central bank, an individual bank will collapse in the event of a bank run. And however, a central bank quickly pumps money as and when demanded by the depositors, reinforcing their confidence, averting the run and keeping the system alive. The next is payment mechanism. Central banks have also made it possible to have a quick and efficient payment mechanism in the economy. This is because the central bank have the ability to ensure that the payment made are irrevocable and guaranteed. Thus, when a bank makes a payment to another bank, it is the central bank that debits one bank's account and credit another bank's account. Since the central bank performs the intermediary function, it frees the commercial banks from counterparty risk, and the commercial bank does not have to worry about not receiving promised payment from another bank. If it is due, the central bank will ensure it is paid. Therefore, the swift function of the fast payment system that we have today is implicitly guaranteed by the central bank. And then the next is financier to the government. The central bank also acts as a financier to the government when the government runs a budget deficit, spends more than it has. The central bank manages the deficits. Those government does not have to depend on the mercy of the bond market in the short run. However, in the long run, the central bank cannot cover all of the government's overspending. Central bank provides valuable support which enables functioning of all of the welfare schemes which require government intervention in the form of money. And then this is the last, with forex management. The central bank also manages foreign exchange reserve on behalf of the government and the common population. Thus, it is the central bank's duty to ensure that the country always has enough foreign exchange on hand to import essential commodities from the international markets. It also has power and the financial muscle required to maintain the value of its currency in the foreign exchange market. If the central bank sends a speculative attack on its currency, they resort to open market operation, thereby maintaining the value at a stable level. I think that's all the explanation that I can share to you. I hope this can help you. Don't forget to give like, comment, and subscribe.